Hello and welcome to the Morningstar series Market Reaction. I'm Emma Wall and I'm joined today by economist for Rathbones Ed Smith to talk about the US election. Hi Ed.
Hello Emma.
So we're here today to talk about the US election. The problem with the US election is almost by the hour the news changes, and part of that is due to the polls. It seems that the polls keep changing their minds about who's going to win. So how much can we trust those statistics?
Well, I think the polls are only as good as the statisticians who adjust the data, adjust the samples for any biases and prejudices. So, historically, whether you're a man or a woman, whether your race, your education, your habitual voting, they're all pretty good indicators of which way you were going to vote, whereas that's no longer the case in the US, in the UK, in Europe, and that's why the polls have been letting us down. Their samples aren't really unbiased. So, and I think that's very much the case in the US. It's not about Democrat versus Republican so much as establishment versus anti-establishment. And so that makes reading the polls rather difficult. We have been looking at bookies odds. But again, they called the UK referendum wrong. The quantity of money suggested that we would remain, if you remember that. But actually, something that nobody looked at the time, but the number of small bets actually suggested that we would leave. Unfortunately, in the US, it's not as clear-cut this time on that data either. So a lot of uncertainty out there. It is possible Trump could win.
From an economist's point of view, this is quite an interesting election. People are drawing comparisons with, as you mentioned, Brexit, and indeed extrapolating that to what that would mean for perhaps the French election, with Marine Le Pen perhaps being an anti-establishment vote in that sphere. However, I think for UK investors, it's important to draw back slightly and look at what that may mean literally for markets, for portfolios, for those people who invest in US equities. So from that point of view, leaving the top line aside, what genuinely does it mean for UK investors?
Well, I think if you're a UK investor, actually, even if you don't invest directly in the US, you still want to pay attention to what's going on, because 20% of FTSE 350 revenues are earned in the US from US sales. Similarly, if you're a global investor like we are at Rathbones, you want to look at what's been driving GDP growth around the world. The US accounts for about a sixth of global GDP and about an eighth of global GDP growth over the last 5 years. Now, we think that the results of the US election could meaningfully impact US growth. Trump, we think, unfortunately, is quite bad news for US growth. Big uncertainty shock. His fiscal plan is almost certainly going to dampen growth because it favours the rich who are likely to save income at the expense of spending elsewhere. Whereas Clinton, better the devil you know, perhaps, less uncertainty, which is better for growth, although she does have some policies that markets might not like there too.
I think Investing 101 leads us to believe that the economy and the stock market are entirely different entities, and what goes on in the economy may not necessarily impact the stock market. However, we have seen increasing correlation over the last couple of years, partly due to monetary policy. So that being said, should investors be eyes open to what's going on in this particular sphere?
Well, I think one of the things we've seen develop over the last few years is quite a close correlation between economic uncertainty and what we call the equity risk premium in equity markets. So how much compensation investors demand for the risks of taking on equity-related cash flows. So we've seen as economic uncertainty rises, and we have some tools to measure that, equity risk premiums go up. All other things being equal, that means lower stock market valuations. So if the results of the US election causes a lot of uncertainty, very elevated levels, that's likely to mean lower stock market correlations. But as you say, over the that aside, over the short term, there's plenty of other things that affect markets other than economic growth. Not a brilliant correlation there, but over the long run, We like to think of ourselves as long-term investors. Although we make tactical decisions, our starting point is a 10-year view. Over the long run, what drives investment returns, taking out all the cyclical noise, is the economy. And so we've got to look at what does Trump and Clinton mean for the drivers of growth? What does it mean for working population? What does it mean for investment? What does it mean for productivity?
And what does it mean for investment? What does it mean for productivity? I mean, I know most people are now coming around to the concept of Clinton for president. Is that a positive thing?
I mean, we think it's certainly more positive than Trump, and really, what's going to drive growth over the next quarter of a century is productivity as working age population slow, as investment slows down for various reasons. Trump's sort of big ticket item is protectionism. That's the death knell for productivity in our opinion. Protectionism by definition shuts off competition, shuts down foreign competition. If you don't have competition, you've got no incentive to make sort of productivity enhancing investments and reforms. One policy that is very good for productivity, public infrastructure spending. That's one of Clinton's big ticket items. About 275 billion earmarked over a 5-year period, including the establishment of an infrastructure bank. That could be good news for productivity.
Thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.